So we are rounding up contestability. So we're going to the cost and benefit of contestability to firms. One of the benefits of contestability to firms are increased efficiency. And when we talk about efficiency, efficiency simply means finding a way to reduce cost. So that means there's productive efficiency and there's X efficiency. There's allocative efficiency, but allocative efficiency is linked to consumers. Do you get the point I'm making here? So when we talk about increased efficiency, we're talking about both productive efficiency and X efficiency. So increased efficiency, the potential for new entrants to challenge existing firms forces them to operate more efficiently, both in terms of production, which is productive efficiency, and minimizing waste, which is X efficiency. So the first advantage firms have when it comes to contestability or in a contestable market is that they are forced to become efficient. Because if they are not efficient, the threat of new entrants might reduce their profitability. So they try to ensure that they can reduce their cost of production and at the same time they can minimize waste. That would allow them to stay afloat in terms of price. Do you get the first point there?
Yeah.
The second one, greater innovation. Firms may invest more in research and development to differentiate themselves and stay ahead of potential competitors, leading to more innovative products and services. In a contestable market where you have low barriers to entry and exit, you need, as a firm, for you to remain relevant, it means you have to invest heavily on research and development. Because when you're able to do that, you'll be able to provide goods and services, new ones, to keep your customers. So being able to invest in research and development might create what we call customer loyalty. And that brings about brand loyalty. Do you understand the second point here?
Yes.
So contestability might allow firms to be more to invest more on innovation. The third one, dynamic efficiency. For dynamic efficiency, we're simply talking about investment in new technology. With contestability, existing firms have to stay ahead. If not, new firms might come up with technology because in a contestable market, remember there's accessibility to technology and information. So which simply means the technology you have, I might as well have them. I might even have a better one than you do have. So firms have to invest heavily on technology so that they can stay ahead of their competitors. Is it clear?
Yeah.
That's the third one. So those are the benefits of contestability to firms. So what are the costs of contestability to firms? The first one, market instability. Why do we have market instability? We have market instability because there's always there's low barriers to entry, which simply means firms can easily come in and go out, and that fluctuates the market share. Because when a new firm comes, what happens? The market share for the existing firms would have to drop because they have to share the market with existing firms. Do you understand? So that means there's always going to be fluctuation in the market share. So, which makes potentially unstable market conditions, making it difficult for firms to plan for the long term. So, because there's always going to be fluctuation of the market share, it doesn't allow existing firms to plan for long term. Because you might plan now that, oh, we're going to produce for 100 customers, but there's a new entrant. There are new firms coming in. Those 100 customers that you think you have will be less. So it means you might not be able to plan ahead of time. Do you understand the first problem about contestability? The second one, reduced long-term investments. Firms may be hesitant to make large long-term investments if they fear that new entrants will quickly erode their profits. In the long term, firms will only make normal profit, where MC equals to what? AC, where AR equals to MR. Do you understand? So at that point in time, it simply means that firms might be reluctant to invest heavily on innovation because they know that in the long term, they are not going to be able to make supernormal profit. So that might discourage them from investing long term. Do you understand the second point here?
Yeah.
The third one, hit and run entry. New firms may enter the market solely to take advantage of temporary profit opportunities and then exit, potentially disrupting the market and leaving consumers with few choices in the long term. The hit and run competitors, they are in the market to make temporary profit. So they get attracted to the market because firms in that market are making supernormal profit. That is the attraction. And as soon as they get to that market, bottom place, okay? For the hit and run entry, they are attracted to that market because the market is making supernormal profit. As soon as they've forgotten that as soon as they come into the market, supply within the market increases, and that increases, that shifts that reduces the price of the product. So the profit, the supernormal profit, start becoming normal profit. And as soon as this normal profit start declining, they leave the market, leaving customers with few choice to make. That is another problem about contestability. Second to the last one, potential for predatory pricing. Existing firms might engage in predatory pricing, selling below costs to drive out competitors, to discourage entry, which can be harmful to the market in the long run. Firms in a contestable market, firms might use predatory pricing to deter potential entrants. And that is not good enough because when you charge predatory pricing, new entrants are not going to come in, but you are also incurring more cost, and you might even make a loss as a result of that. And the last one, reduce incentive for innovation. If entry is too easy, firms may, we call these highly contestable. If entry is too easy, firms may not invest heavily in research and development as their innovation could be easily copied by new entrants. One of the reasons why we have more investment in research and development is that firms have what we call intellectual property. But with free entry and exit, there's no intellectual property, which simply means new firms can easily copy your own idea. Then what's the point investing in innovation or research and development? So these are the costs and benefits of contestability to firms. Any question about it? Good. So that takes us to, sorry, I think I have costs and benefits of contestability to consumers now. So go to cost and benefits of contestability to consumers. The first benefit, prices tend to be lower and nearer to the prices in the competitive market because the threat of new entrants resulting into existing firms becoming more efficient, more productive efficient. So this favors consumers. The first benefit of contestability to consumers is that prices tend to be low. And the reason why prices are low is because there's a threat of new entrants. So if new entrants comes in, they come in and they might take over the market. So that threat alone makes existing firms to be productive efficient. And if they are productive efficient, it means their average cost of production continues to fall. That allows them to sell at a reduced price. That keeps their customers. So this makes customers to buy at affordable prices. Is it clear? The first one. Is it clear, please?
Yeah.
The second one, the dominance of large firms in a contestable market may allow economies of scale to be exploited. This may lead to lower prices being charged, which increases consumer surplus. With contestability, consumer surplus are expected to increase. Why? Because large firms, especially if there are large firms in that market that dominate that market, it means they can still operate, they can still exploit economies of scale. Their ability to exploit economies of scale means the prices they're going to charge would reduce, and that increases consumer surplus. Is it clear?
Mm.
And the third one is allocative efficiency. You know, when we started, I talked about productive efficiency, X efficiency, which are for firms, dynamic efficiency for firms. But when it comes to allocative efficiency, we are referring to consumers. And what is allocative efficiency? It means consumers are able to buy the product, they are able to get the quantities needed at affordable prices. So allocative efficiency, here I wrote, firms in a contestable market produce where AR equals to MC. That is where they produce at a reduced cost, right?
Mm.
And where MC equals to AC. This implies that there's increased incentive for firms to respond to consumer preferences. Firms, because it's a contestable market, you put more reference to your customers. You don't ignore your customers, because if you do, your competitors will snatch them from you. As a result of that, you have that incentive to always respond to the needs of your customers, because that is the only way you can keep hold of them. Do you get it?
Yeah.
However, then what is the cost of contestability to consumers? If there are fewer firms in the market due to hit and run competitors, consumers' choice may be limited. Remember, in the contestable market, there's free entry and exit, which simply means, or there's low barriers to entry and exit, which simply means new firms might come in because they are attracted to supernormal profit. So if new firms are coming in because they are attracted to supernormal profit, as soon as they come in, supply increases, price falls. So there's not going to be supernormal profit, there will be normal profit. And as soon as this normal profit declines, those hit and run competitors, they leave the market again, yes or no? Because they are there for temporary profit. So they run away again as soon as profit declines. This means choices for consumers would reduce. And remember, with contestability, existing firms do not have the opportunity to plan ahead because the market share is always fluctuating. So they might not have enough product or service available for existing consumers because of the hit and run competitors. Is it clear? Any question about that? No. So that takes us to the degree of contestability. So the last note is on degrees of contestability. We said a contestable market or contestability in the market refers to the ease with which new firms can enter and compete with the existing firms. That is what contestability is, right? Good. So what does that simply mean? It simply means that there's need to put into consideration barriers to entry and barriers to exit whenever we want to talk about contestability. So what are those barriers to entry? The first barrier to entry is sunk cost. And when we talk about sunk cost, we're talking about costs that cannot be recovered. So if new firms figure out that there are some costs that cannot be recovered for them, they will be discouraged to set up into that industry. So high sunk cost is an hindrance to setting up in the market. So if there's high sunk cost, then the market might not be contestable. That's the first one. The second one, access to technology and skilled labor. If new firms find difficulties to get necessary technology or skilled labor, it may be difficult to compete. So if you want to compete, but you don't have access to technology, you don't have access to the skilled workers needed to compete, then it will be difficult for you to start to set up in that market. That's another barrier to entry. The third one is access to the third one is brand loyalty. Established brands deter new entrants by creating strong customer loyalty. There are existing firms in the market, yes or no? So these existing firms might have sell at a reduced price, which has created, a strong brand for them or customers, loyalty. So you coming into that market and trying to convince their customers might take a lot of time and energy. So that might discourage you from setting up. So if there is brand loyalty in the market might be less contestable. Do you understand? Then we have the barriers to exit. Barriers to exit, we're talking about the cost associated with leaving the market. If the cost associated with leaving the market is less, then the market might be highly contestable. Do you understand? And the last one is the threat of new entrants. Even if a market appears to be dominated by a few firms, the potential for new firms to enter can still make it relatively contestable. So the market can still be relatively contestable if there's threat of new entrants. So which simply means there's few or weak barrier to entry and exit. So these are things we need to put into consideration when we're talking about the extent to which a market is contestable or not contestable. So now we go to the degree of contestability itself. So the degrees of contestability, we have highly contestable, we have less contestable, and we have perfectly contestable. So we're going to start with highly contestable. Markets with low barriers to entry and exit are considered highly contestable. This implies that new firms can easily enter and exit, and existing firms must remain competitive to avoid losing market share. A market is highly contestable if there's low barriers to entry and exit. So what will the response or the behavior of existing firms be in such markets? They need to remain competitive. If they're not competitive, it means they're going to lose their market share to the new entrants. So that is about a highly contestable market. A highly contestable market is a market that has low barriers to entry and exit, and it can be considered highly contestable because At that point in time, new firms can easily come in and go out at any point in time. So for firms, their response should be they must remain competitive. I think a highly contestable market is clear. We're still talking about the degree of contestability. Then the second one is less contestable. A market is considered to be less contestable if there are high barriers to entry and exit. So in that market, existing firms can potentially earn higher profit without thinking about potential for new entrants or potential threats from new entrants. So a market is less contestable because existing firms in that market can as well make high profits without thinking about potential of threat from new entrants. Is it clear? And the last one is perfectly contestable. This is a theoretical idea where there are absolutely no barriers to entry or exit. There's no market in reality that perfectly fits into that definition. There's no market that is perfectly contestable. So every market that we have is either highly contestable or less contestable. It's highly contestable because the barriers to entry and exit are weak, and it is less contestable because there's high barriers to entry and exit. But even if it is less contestable, it doesn't mean that there's no barrier to entry and exit. So there's no market in the world that has no barriers to entry and exit. Do you get it? Any question about it?
No.
So that ends contestability. Please.